The dollar just bounced, and if you think the crisis is over, you're not paying attention. This is exactly how currency collapses begin, with relief rallies. This decision could affect your savings faster than the 2008 crash. Let me explain what just happened. Trump named Kevin Warsh as his pick to replace Jerome Powell at the Federal Reserve. The moment markets heard the name, the dollar surged, up 0.6%, trading at 96.82. Wall Street exhaled. Headlines declared the Fed independence crisis was over. But here's the part most people won't understand until it's too late. The dollar is still down 0.8% this week, still near 4-month lows, still on track for its second consecutive weekly decline. If you save money, invest money, or earn in dollars, this affects you directly. Now watch carefully. This isn't a recovery. This is a pause. The structural problems haven't disappeared. They've just been temporarily overshadowed. There's one risk Wall Street doesn't want retail investors to notice. The same administration that just calmed markets with the Warsh pick is simultaneously stirring up geopolitical chaos that's dragging the dollar down. New tariffs on countries providing oil to Cuba, potential strikes against Iran, ongoing tensions with Venezuela, Greenland, and Europe, and a president who, by his own admission, wants a weaker dollar. I've studied Fed cycles longer than most Wall Street analysts. I've seen this pattern more than once in my lifetime. When the people who control money start fighting over who controls the controls, that's not noise. That's a regime change in motion. This affects your rent, your groceries, and your children's future. By the end of this, you'll understand exactly why the dollar bounced, why smart money isn't celebrating, and what this means for your purchasing power through 2026 and beyond. Bookmark this. We'll test these predictions in 90 days. This isn't about politics. This isn't about ideology. This is about incentives. Pure, cold, unavoidable incentives. I've spent decades watching currencies, watching what happens when central bank leadership changes, watching how policy shifts ripple through every asset class on the planet. And I'll tell you something simple. When a currency bounces on relief, but the structural headwinds remain unchanged, you don't celebrate. You prepare. Here's the answer. 3 data points, 3 pressure points. Each one alone is significant. Together, they create a Lollapalooza, a compounding of forces that will determine whether this dollar bounce holds or fails. But the third data point is the one that turns optimism into caution. But the real danger isn't what happened today, it's what happens next week. And this is where the pattern becomes impossible to ignore. Here's the first signal. The moment Trump announced Kevin Warsh as his Fed chair pick, the dollar rallied, up 0.6%, trading at 96.82. Now zoom out. Why did markets react this way? Because Warsh calmed the biggest fear Wall Street had, that Trump would pick someone who'd destroy Fed independence. Eric Thiel, Chief Investment Officer at Comerica Wealth Management, explained it directly. The selection of Kevin Warsh should calm concern about the erosion of independence of the Federal Reserve. His candidacy included prior experience as a Fed governor and as an investor. Here's the trick. Warsh isn't a political operative. He's not a yes man. He served as a Fed governor from 2006 to 2011. He was Ben Bernanke's chief liaison to Wall Street during the financial crisis. He has credibility. And crucially, he has a hawkish history. That matters because the market's biggest fear wasn't that Trump would name a Fed chair. The fear was that Trump would name a puppet, someone who'd slash rates recklessly, someone who'd print money on command, someone who'd sacrifice long-term stability for short-term political wins. Warsh isn't that. Thiel added the key insight. He has been flexible on monetary policy in the past and will likely take the most strategic approach toward the role of the Federal Reserve mission going forward. Pause. Forget politics. Think like capital. Capital doesn't care about party affiliation. Capital cares about predictability. And Warsh represents predictability relative to the alternatives. That's why the dollar bounced. Not because the problems are solved, but because the worst-case scenario, a Fed captured by politics, just became less likely. Here's the uncomfortable truth. Relief rallies are dangerous. They feel good in the moment, but they often mask deeper problems. And the deeper problems haven't gone anywhere. When incentives align like this, outcomes stop being opinions and become math. But the real shift hasn't started yet. Keep this in mind. It connects to everything that comes next. Now the second data point, and this is where the situation turns serious. Despite Friday's rally, the dollar is still near 4-month lows, still on track for a 0.8% weekly decline, still heading for its second consecutive weekly loss. Here's the uncomfortable truth nobody wants to say out loud. The Warsh announcement calmed one fear, but it didn't address the others, and the others are multiplying. Let me walk you through what happened just this week. Thursday night, the White House announced that Trump signed an executive order imposing tariffs on countries that provide oil to Cuba. More tariffs, more uncertainty, more reasons for global capital to question whether the U.S. is a stable place to park money. But that's not all. There are concerns that Trump is considering strikes against Iran to push a nuclear deal, ongoing tensions with Venezuela, friction over Greenland, escalating disputes with Europe. Now here's the part Wall Street is quietly nervous about. David Morrison, senior market analyst at Trade Nation, explained the situation bluntly. There's a big sack full of negative sentiment sitting on the U.S. dollar currently. The Trump administration has certainly played its part, and it continues to stir things up geopolitically. But here's the key part of his analysis. At the same time, nothing has changed in relation to the dollar as far as President Trump is concerned. It is well known that he favors a weaker currency as he sees this as a way to boost U.S. exports. Let that satisfactorily sink in. The President of the United States wants a weaker dollar. He's said so publicly. He believes a weaker currency helps American exports. And his policies, the tariffs, the geopolitical aggression, the uncertainty, are all pushing in that direction. Now zoom out. Think about what this means for capital flows. If you're a foreign investor, a sovereign wealth fund, a central bank, a pension fund, and you're watching the U.S. administration actively pursue policies that weaken the dollar, why would you increase your dollar holdings? Why would you park more capital in a currency whose own government wants to devalue it? This is where the math gets dangerous. Morrison continued with the crucial warning. But others see it as malign neglect and wonder if the current weakness may become permanent and therefore a permanent loss of privilege for the dollar as the world's reserve currency. Read that again. Permanent loss of privilege for the world's reserve currency. That's not me being dramatic. That's a senior market analyst at a major trading firm. Now here's the twist. Morrison added something important. Maybe. But while another lurch lower can't be ruled out, some investors are considering if this could be a buying opportunity, so traders should look out for any signs of bottoming. This is the turning point. Some traders see this as a potential bottom. A buying opportunity, a chance to scoop up dollars at multi-month lows. But here's the risk. If the administration keeps stirring up geopolitical chaos and keeps pursuing policies that weaken the dollar, the bottom won't hold. And what looks like a buying opportunity becomes a falling knife. When the people who control money actively want that money to lose value, everything downstream must adjust. And this is where the system starts shifting. Now the third data point, now here's the part most people skip, and that's a mistake. This next section is quiet, but it matters more than Warsh. Because the dollar's bounce happened against a backdrop of significant moves in other major currencies. Let me break down what's happening around the world, because this isn't just a dollar story. This is a global currency realignment. Europe, steady growth, but euro retreating. The euro fell 0.7% against the dollar on Friday, trading at 1.183. But here's the context that matters. The Eurozone just reported GDP data, and it was better than expected. Spain expanded 0.8% quarter over quarter, well above the 0.6% forecast. Germany, the Eurozone's largest economy, grew 0.3%, beating expectations. France came in at 0.2%, exactly as predicted. Italy grew 0.3%, slightly above forecast. The Netherlands expanded 0.5%. Now here's the uncomfortable truth. Europe is growing, modestly but steadily, and yet the euro fell against the dollar. Why? Because currency markets aren't just about growth. They're about relative expectations. And the Warsh announcement shifted expectations in favor of the dollar. at least temporarily. But here's what most people miss. The euro's strength earlier this year wasn't about Europe being strong, it was about the dollar being weak. When the dollar recovers, even briefly, the euro gives back gains. That's mechanical, that's arithmetic, and this is where the pattern becomes impossible to ignore. United Kingdom, pound, pulls back before BOE meeting. The British pound fell 0.6% against the dollar, trading at 1.3723. That's a retreat from levels not seen since October 2021. Now here's why this matters. The Bank of England has a policy meeting next week, and the pound's pullback ahead of that meeting tells you something about market expectations. Traders are positioning for potential dovishness, for the BOE to signal rate cuts, or at least hold off on further hikes. Here's the short version. The pound rallied hard earlier this year on expectations of BOE tightening. Now those expectations are being questioned, and the pound is retreating. When central bank expectations shift, currencies move. That's cause and effect. That's incentives in action. Japan, inflation collapses, yen weakens. Now here's the most interesting move of the day. The dollar rose 0.8% against the Japanese yen, trading at 154.30. But the yen is still on course to gain almost 2% against the dollar in January. Now here's what drove Friday's move. Consumer inflation data in Tokyo, which acts as a bellwether for nationwide inflation, came in shockingly weak, the weakest level in nearly 4 years. Pause. Forget politics. Think like capital. The Bank of Japan has been trying to normalize policy, to raise rates, to finally exit decades of ultra-loose monetary policy. But that plan depends on inflation staying elevated. If inflation collapses, the BOJ has no justification for rate hikes. And if the BOJ can't hike rates, the yen weakens. That's exactly what happened Friday. Here's the twist, though. The yen had been strengthening sharply over the past month, recovering from 1.5-year lows. Speculation was building that Tokyo might intervene in currency markets to support the yen. Prime Minister Sanai Takaichi even warned about excessive bets against the yen. Now zoom out. Think about the game being played here. Japan wants a stronger yen, but weak inflation data makes rate hikes harder. The U.S. wants a weaker dollar, but Warsh's nomination temporarily strengthened it. Everyone is trying to manipulate their currency, and when everyone is manipulating, volatility becomes inevitable. China and Australia, diverging paths. The dollar edged higher against the Chinese yuan, trading at 6.9510. China continues to manage its currency carefully, balancing export competitiveness against capital flight concerns. But the more interesting story is Australia. The Australian dollar fell 0.7% against the greenback on Friday, trading at 0.6996. But here's the key context. The Aussie is still near a 2-year high. Why? Because markets are increasingly convinced the Reserve Bank of Australia will hike interest rates next week. Consumer inflation data for the fourth quarter showed a sharp increase. And when inflation rises, central banks hike. That's the playbook. Here's the uncomfortable truth. Australia is hiking while the U.S. is expected to cut. That interest rate differential favors the Aussie, and over time, capital flows toward higher yields. This is where most people get lost in the complexity. But here's the simple version. Currencies move based on 3 things: interest rate differentials, economic growth expectations, political and geopolitical stability. Right now, the U.S. is losing ground on all 3. Rates are expected to fall. Growth is uncertain. And the administration is generating constant geopolitical noise. That's why the dollar bounced on Warsh, but remains structurally weak. The bounce addressed one concern, but the underlying fundamentals haven't changed. Why these 3 forces together create the real picture. Now let's connect the dots. Because this isn't random, this is a pattern. You have the Warsh effect, calming fears about Fed independence and triggering a relief rally. You have the administration effect, generating constant uncertainty through tariffs, geopolitical aggression, and explicit preference for a weaker dollar. You have the global currency effect, with major economies and central banks all adjusting to the new reality. 3 different forces, three different directions. One conclusion: volatility isn't ending. It's just getting started. Relief rallies calm headlines. They don't fix currencies. When incentives conflict like this, markets don't find stability. They oscillate. Now let's invert. What would have to happen for the dollar to stage a sustained recovery? The administration would have to stop pursuing policies that weaken it. Geopolitical tensions would have to ease. The Fed would have to signal a more hawkish path than currently expected. Foreign capital would have to regain confidence in U.S. stability. Does that sound likely to you? I didn't think so. Here's the math that matters. The dollar bounced 0.6% on Friday, but it's still down 0.8% for the week. Still near 4-month lows, still in a structural downtrend. One day of relief doesn't change the trajectory. When incentives align like this, the outcome stops being a guess and becomes a mathematical inevitability. The dollar may bounce further. But until the underlying incentives change, every bounce is a selling opportunity, not a buying opportunity. By mid-2026, we'll know if this was a turning point or just a pause before the next leg down. So where does this end? Let me give you the honest assessment. The bull case. Warsh gets confirmed. He restores confidence in Fed independence. The administration moderates its geopolitical aggression. Tariff uncertainty fades. Foreign capital returns to the dollar. The currency stabilizes and potentially strengthens. The bear case. Warsh faces a brutal confirmation fight. Powell stays on as governor and creates friction. The administration keeps stirring up geopolitical chaos. The president's preference for a weaker dollar continues to drive policy. Foreign capital accelerates its exit from dollar assets. The currency breaks to new lows. The most likely case: something in between: volatility, uncertainty, bounces that don't hold, declines that don't crash. A grinding, messy transition as the world's reserve currency slowly loses its premium. Here's the sentence that tells you everything. David Morrison at Trade Nation put it perfectly. Others see it as malign neglect and wonder if the current weakness may become permanent and therefore permanent damage to the dollar as the world's reserve currency. That's the stakes. Not a technical correction, not a temporary dip. A potential permanent shift in the global monetary order. A weaker dollar doesn't announce itself. It shows up as smaller grocery bags and higher rent. Now here's the good news, if you can call it that. There was a deal reached to avert a partial government shutdown. The White House and Senate Democrats agreed. One less source of uncertainty. But here's the uncomfortable truth. One piece of good news doesn't offset the mountain of uncertainty. This isn't noise. This isn't politics. This is a structural shift. Money is losing honesty, and markets can feel it. The dollar has been the world's reserve currency for 80 years. That status was built on trust. Trust in American institutions, trust in the Fed's independence, trust in policy predictability. All three pillars are being tested simultaneously. And by the time most people realize what's happening, the adjustment will already be underway. So what do you do with this information? Three things. Cold, logical, no emotion. First, understand the Warsh effect correctly. The dollar bounced because Warsh calms fears about Fed independence. But that doesn't solve the structural issues. The administration still wants a weaker dollar. Geopolitical chaos continues. Foreign capital is still cautious. Don't mistake a relief rally for a trend reversal. Second, watch the confirmation process. Warsh needs Senate confirmation. Senator Tillis is blocking all Fed nominees until the Powell investigation is resolved. Powell might stay on as governor. Friction is coming. Uncertainty continues. Third, recognize what the global picture is telling you. Europe is growing steadily. Japan is struggling with collapsing inflation. Australia is likely to hike rates. China is carefully managing its currency. Each of these dynamics affects dollar flows. And right now, the flows are not decisively favoring the greenback. Fourth, prepare for volatility, not stability. The dollar may bounce, it may fall, it will almost certainly oscillate. If your wealth is 100% denominated in dollars, savings, investments, income, you're making a concentrated bet that this turbulence resolves in America's favor. That's not a plan, that's a gamble. Fifth, think about purchasing power, not just price. The dollar can stay at 96.97 on the index. But if inflation runs hot while your income stays flat, your purchasing power is still being destroyed. This affects your rent, your groceries, your children's college fund, your retirement. None of this is advice. All of this is arithmetic. I've spent my whole career trying to understand incentives, and right now the incentives are conflicting. Warsh wants to restore Fed credibility. Trump wants a weaker dollar. Foreign capital wants stability. The administration is generating chaos. When incentives conflict, volatility wins. When the people who control money fight over who controls the controls, everything downstream must adjust. This isn't about morality. It's about simple arithmetic. Subscribe if you want to think like capital, not like victims. I'll keep following the numbers so you don't have to guess.